Hi students, welcome to the finance webinar from the Prep Leaf and to help you in your placements. So I'll first start with my introduction, a very brief one, and then we'll move on to the webinar. So I am IIT Delhi pass out from the batch of 2017. I have done my integrated MTech in mathematics and financing. After that, I have joined JP Morgan as an equity research analyst, spent around 2 years in with JP Morgan, and now I'm currently working with Deutsche Bank as a trading position where we facilitates the margin loan desk. And I have also completed my CFA, all three levels, waiting for my charter. So this is about me. So the roadmap for the webinar is, so we'll first discuss what are the opportunities in finance are, then we'll move on to the fundamental side covering both equities and bonds, and then we'll move on to the derivatives, the technical side of the field, and then there will be an assignment and I'll tell you little detail about the courses that the Prep Leaf is offering. Now, so the opportunities in finance given for the technical college, for the college like IITs, and for the students who are doing the engineering in the core sides. So there are two sets in which we can bifurcate the opportunities that are presented in front of us as the guys from the technical college. So the first is the core sector, the core finance sector, which involves investment banking, corporate finance, global markets, and asset management. So this is the role which is basically the core in the finance sector where everyone wants to be. But given we are from the technical college, it is somewhat a little difficult for us to tap into this particular section of the field, and the opportunities that are here. So the companies which hire for this particular segment are basically mostly all the banks who do all their investment banking, the Fin, the CorpFin, and the GMG business. The second one is the ring. I prefer to call it as ring, and it's not a very standard bifurcation, but this is how to define. This bifurcation is done to give you a sense like where we are placed and how we can enter into the finance. So this ring is basically a rapidly growing sector in this particular industry, and this involves the financial technology sector, the quantitative side of finance, and then HFTs and those kinds of trading opportunities. So the companies which hire for these roles are mostly again all banks, then there are independent firms, then there are tech startups who have basically started tapping into the HFT segment. So this is the one place where you guys can have a good shot to enter into the finance field. Now, I'll just give a brief idea about what an ideal CV is for both the roles. So, for the core, if any one of you have done any CFA, any level 1 or level 2 qualification, or if you have done some assignments, some courses, or something even remotely related to the field of finance, that's a good place to start with. Now, to enhance your capabilities and to enhance your probability of getting shortlisted and selected in these particular roles, so one thing to note here is that not many profiles come for these roles in colleges like IITs. So you'll see most of the roles are from the ring segment, and from the core there are only few uh, roles which you will be looking for. So that's the core. For core, you need a very fin heavy CV. You need to give them that impression that not just you are not just interested in the finance for the lucrative businesses and the lucrative incomes that basically you earn in this field, but basically something it's this field genuinely interests you. So the best probability for us to tap is the ring. But one challenge that the ring gives us is you need to have a strong either quantitative side or the strong coding side. So even so, to sum it up, the three out of three, either you need to have a very high finance, or you need to have a very high coding, and or you need to have a very high quantitative side. But what for the peoples who does not have any of the three is the best place for them is to have a little bit of finance. So you can do a couple of courses from here and there, either from your college, or you can do couple of courses from the online providers You can then have a couple of courses from probability and stochastic and statistics things, and then a couple of courses in coding, just the 101. So basically, if you have even the 101 exposure from these three fields, you are well placed to tap into this field. Because when companies come to hire from colleges like IITs for the roles like finance, they do not expect you to be a good champ in the finance. They do not expect you to compete on day one with the MBA guys who have spent about 2 years in studying finance. So this is one thing you need to understand is, like, you are not at all at any disadvantage. What you need to have in your CV is, you need to give the recruiters the impression that you are well placed, you understand what the role is, you understand what exactly is asked from you or is required from you, and you give them that impression, okay, I have a little bit of all the things which are basically required for me to excel in my job in finance. So this is the course structure. And again, with respect to the timing, still you guys have enough time under your belt uh, to have the 101 exposure of the three fields. You can definitely do some courses from Preply, from other providers as well, for the finance thing. I think this is the only thing which most of you don't have. So if you are really interested in tapping into this field, or if you are really interested in even exploring this field, go for the courses that we are offering, or even from someplace else if that's the concern. Just if you want to check out, like, if you are genuinely interested in this field, or if this field excites you, so have a course from all the three domains: the probability and stochastic statistics course, the CSL, which is the computer science 101 course, and the third one is the finance. So the more you have on finance side, the better for you. But the basic intro for these three fields is more than enough for you to tap into this thing. Now we'll start with uh, that said, I'll start with giving you some background of the knowledge that I can share in this little time from the financial statements. Then we can go on to the derivatives, and then we'll give you an assignment at the end of this webinar, which you can do, and then you can post your queries on the forum. Now, the one, so feel free to post your doubts on the forum if meanwhile you have any in while I'm presenting. So the three statements. Now we'll jump directly into the academia side. Don't think this of as a I'll study it from someplace else, because what I am trying to give you now in this 1 hour, if you just sit enough and don't do anything, just listen to me, you will have a good enough idea of what the finance is, what the things that you need to prepare for, and where you can prepare from. So I'll start with the financial statements, then we'll move on to the bonds, and then the derivative side. So when we say financial statement, so any company, now we need to understand the difference between the public and a private company. So a private company is a company like, you say Flipkart is a private company, then you go to Myntra, and to the very small shop that you see in your own locality selling toys, selling kirana, groceries, and those things. So these are all the private firms or private companies. Now, what a public company is. So the only stark difference between a public and a private company is, so a public company is something which has diluted its shares and which now offers its shares on the stock market for the common public to invest in. So I cannot go to that toy shop in my locality and just say him, okay, take some of my money and give me the ownership in your shop, that I'll be the partner in your shop and I'll be sharing the profits on the 10% basis and you take the initial amount. This cannot be done. This cannot be done with the private companies, not in most of the cases. So what happens is, so when a company reaches a limit where basically if a, let's take the case of Flipkart, so they are expanding. So now they think that they have reached a very good scale, and now they want to expand very heavily again, either to the, let's say, local villages in India, or they want to tap the international market as well. So what happens is, when a company decides that this is what they need to do, or if for any other reason they need some large inflow of cash with them, so what they do is they go to the public markets. So when we say public market, this is a stock exchange. So they go to the stock exchange. Now please do not mind if some of you know the nitty-gritties of the field. I'm trying to explain the things in the very layman terms so that the most of us understand. So don't mind if you feel that this term does not fit here or those kind of thing. So if Flipkart decides that they want to expand or they want some inflow of huge cash, so it's not possible after a time that that inflow of cash can come from investors. So this thing is very common these days, that you open a startup, that you look for the funding. So once you basically squish that funding aspect in the market, where the private funding is basically no more can be done, or they do not want to dilute the ownership again, because private funding comes at a very high cost of dilution. So if any private investor, any private equity investor is investing, wants to invest a good money in Flipkart, they basically want about, let's say, 5%, 7%, 10% of the company. So instead of doing this and making them a critical partner in the firm, what the Flipkart can do is Flipkart can divide, let's say, Flipkart can divide the 100% of Flipkart into small number of shares. So let's say they divide it into the 100 crore shares. Now that this 100% of Flipkart is now represented by 100 crore shares. And what the investment bank guys will do, they'll basically come up with a valuation of Flipkart. They'll assign a price to that particular share. They'll do a thing called IPO, which is the initial public offering. So they'll basically do their IPO. They'll list, let's say, of that 100 crore shares, they'll list about 5 to 7%, or depend it. Now everything here, on when we talk about numbers, it all depends upon what the owners of the company wants to achieve from this particular thing, and what are the basic legal and the regulatory rules that they need to satisfy. And once everything is done, it's up to the company if they want to list about, let's say, 7%, 15%, 20%, or 30% of Flipkart on the market. So let's say if Flipkart decides to uh, go with 30% of the company, so the 30 crore shares of Flipkart now are available on either the Bombay Stock Exchange or the NSE, National Stock Exchange, and people like you and I basically can open our demat accounts and then can start trading in those shares. So I can, if I feel okay, I feel that when Flipkart is trading at about, let's say, 100 rupees for an example, and I feel that this is not the ideal valuation, feel at the end of the webinar you'll understand what I say about the valuation. If I feel that 100 is not the justified price, I feel that it should be trading at 160 rupees. So I'll open my demat account, I'll place an order, and depending upon my wish, I'll buy 10, 20, 15, 30, 40, and whatever number of shares I wish. So this is the one difference between the public and a private company. Like a public company, any common people like us with a demat account, who has a demat account, can invest in the public company, but this is something not possible for the private company. Now, for the people like us, when any particular system is established in with respect to the finance now, so when this particular setup is started, where people like you and I can invest, it goes without saying that we definitely do not have any information about the company. We will definitely not be tracking it on a daily basis. So what happens is, now every public company has this requirement to publish their financial statements, which basically now will capture their performance throughout the period. So the basic requirement is they'll post their financial statement on a quarterly basis and a detailed statement at the end of 6 months and 12 months. Now, once now we understand this, like what's the difference between the private and the public firms are, and once we have invested in Flipkart, let's say once it's public, so at the end of every 6 months or annual, at the end of every year, we'll receive the financial statements. So they'll uh, come out to the public. Flipkart management will come out to the public, and they'll say, okay, this is the performance of a company in this particular year. This is how what we have done. Now, to understand what the company says, so basically we need to understand the three financial statements, what they are and what basically they explain. Now, so the first of the three statement is the income statement. So the first of the three statement is the income statement. So what the income statement gives you is, so I'm not getting into detail about the accounting policies. So all these three statements are made keeping in mind the accounting policies that the Indian public firms need to abide with. So what income statements will tell you? So it will start with revenue. So revenue will tell you how much sales the company has done in this particular year. So this component will give you the leftmost component of revenue. Let's say the company has done about 10 crore in sales in this particular year. Now the aim, when we look at the income statement, we try to assess what is the bottom line, uh, another term for the profit or loss. So we try to assess how the company has fared in this particular year. So they'll give us this information. Okay, this is our revenue, and then this is the expenses that we had occurred in this particular year, and this is our profit or loss. Now when we say it like this, it's the income statement is not just a three line thing. So what they'll do is they'll start with revenues, then they'll subtract the cost of goods sold, and this will give you the gross profit. So this tells us the gross profit is what the company's buying price is and what the company's selling price difference is on an average. So if let's say company buys good worth of uh, 12 crore rupees and they sell it at let's say 20 crore rupees, so the revenue would be 20 crore rupees, the cost of goods sold arrive at 12 crore rupees, so this gives me my gross profit of 8 crore rupees. Now this is what basically we understand by profit or loss. This is what our layman understanding is when we say about profit or loss. But when you run a company, there are other expenses as well, and they are in considerable proportion to the other expenses as well. So when you arrive at this 8 crore profit in the gross profit, you subtract other expenses. And what the other expenses are, for the case of Flipkart, it will be the employee cost that the Flipkart pays out to its employees for running the company, then the warehouse costing that it has, the rent that it might be paying for some furniture or some offices that it has lent out. Then there are other electricity costs. So once you subtract these costs, these are the operating costs. So once you arrive at gross profit, then you subtract these operating profit, then you subtract the depreciation and amortization. So I won't go into the details what the depreciation is, but just to give you a flavor, when any company buys a asset which is very costly at the start of the year, and it is expected that this particular asset will give them benefit for let's say 5 or 10 years. So what they do is, if the cost of that asset is 1 crore, so they do not take that 1 crore as cost, they divide the cost into the 5 or 10 years, whatever the number of years the asset is expected to give the benefits to the company. So if that particular machine, let's say, runs for 10 years, the life that we assume is 10 years and the cost is 1 crore. So basically each year we'll take the cost from that particular asset as 10 lakh. So this is the depreciation thing. So once you subtract all these administrative, all these operating expenses and the depreciation and amortization, you arrive at EBIT. This is the earnings before interest and taxes. So this then basically now gives you an indication what the company is earning before paying its interest and taxes. So interest and taxes are basically more of an obligation to a company, which company can definitely change the quantum, but it's very difficult to change the amount of tax that company pays, and to change the interest amount is again depends bit on the policy that the company is following. So this EBIT is again a very good indicator how the company is doing. So then many of the startups that we say are currently in India aiming to be the EBIT positive. So leave the profit, net profit that you take your home at the end of the day, they are definitely not the in profit. The current what the e-commerce in India is trying to do, they are just trying to be the EBIT positive. When we say EBIT positive, they just revenue minus the cost of goods sold minus the other expenses which are related to running the business. They are just trying that this particular component, this particular equation is positive. Once you arrive at EBIT, now what other obligation remains is you need to pay interest, the company needs to pay interest and taxes. So once let's say the EBIT amount is 5 crores, So out of this 5 crores, let's say the interest cost is 1 crore. So company will pay 1 crore out of this 5 crore. This will give them the profit before tax. So the profit before tax is 4 crore. And out of this 4 crore, let's say they have a straight slab of 30% tax. So they'll pay the 30% tax of 1.2 crores, and then they are the company remains with the profit of 2.8 crores. So what the what this particular statement has given us is that what are the total revenue that the company is earning, what are the different components of expenses that the company has, what is the interest and the taxes they are paying, and what is the final profit. So the figure of 2.8 crore, this is what the owners of the company are taking in their pocket at the end of the year. Now, when we say at the end of the year they are taking this into their pocket, this does not mean that this 2.8 crore is divided equally amongst the 100 crore shares that the company has. So basically, now it depends upon the company as a Flipkart what they want to do with this as 2.8 crores. Either they can distribute as the dividends. Everyone must have heard about this term called dividend. So what every company does is they every quarter, every half year, and every yearly, depends upon the company policy, they will distribute their earnings if they are earning handsomely, and if they do not have much use of cash with them, they'll distribute their income as dividends. So let's say the Flipkart decides that of the 2.8 crore earned in this year, let's distribute the 1 crore to the shareholders, and then let's invest the remaining 1.8 crores or keep it with us so that we can invest it in the different opportunities as and when they come due, and either we take it with us and basically keep it with us if any emergency arrives or do for those kinds of things. So this particular statement explains the operating performance of the company, how the company as an entity has performed and has done its business of earning money in this particular year, and the different components, and we can analyze the different components across time. So let's say if when we are analyzing Flipkart, we see that their profit is declining, that each year their net profit margin, which is calculated as the profit or loss termed as net profit divided by the revenue, if the net profit margin is, so in this case, when we said that the revenue is 20 crore and the net profit is 2.8 crore, so their net profit margin would be 2.8 divided by 20%. So if we see that across years from last 3 years, its net profit margin is decreasing significantly. So we can then analyze the different components of the income statement and see from where the impact on the net profit is coming. If the revenue is shrinking, if the expenses are increasing, if both revenue is shrinking and expenses are increasing, or a combination of that. So this income statement gives us that picture. Now the second most important financial statement is the balance sheet. So what balance sheet gives us, it does not tells us the performance of the company in any particular year. So this is a snapshot of company's position at a point in time. So while the income statement is telling us the performance from 1st of April 2019 to 31st of March 2020, this statement is giving us the snapshot of the company's position as of 31st March 2020. So, what the balance sheet is? So, let's try to understand it by the example of the house mortgage. So, let's say you own a house. The house is worth 1 crores, and you have paid the 30 lakhs out of your pocket. You have saved for few years, and now you have 30 lakhs with us, with yourself, and you have used that 30 lakhs for buying a house. And the remaining 70 lakh is basically you funded by taking a loan from the bank. So what your asset here will be, the asset is house which is worth 1 crore rupees. What your liabilities is the 70 crore loan that you have taken from the bank. What the shareholders equity is, the portion of that particular asset that you own by yourself. This is the portion which is the 30 lakhs that you have paid out upfront. So this is the portion that you have paid out, and this is what you own. So this is the balance sheet formula or the balance sheet equation that holds true every time for every company. This will hold true that assets will equals to liabilities plus shareholders equity. And to understand this thing, assets are something which are going to give us the assets are something which are going to give us the future economic benefits. Liabilities are something which basically we need to pay back, or these are the obligations we as a homeowner or Flipkart as a company needs to basically fulfill. Otherwise, there will be a legal battle that they can get into. So these are the this is the difference between the asset and the liabilities. So asset is basically uh, a property or an asset which is going to give me the future economic benefit, but is so what happens is when you go out and buy a asset, you are basically paying some amount today, and that particular transaction is going to give you benefits in future. What the liabilities are, you are getting money today, but then you need to pay it back in future. And what shareholders equity is the difference between the two. So this is the amount of money that the owners of the company had paid out, or had basically they had paid out for the buying of that particular asset. So in terms of the different companies, now what you can understand here is, and with this particular financial statement, is that assets are funded by the combination of liabilities and shareholders equity. Now, the very basic thing to understand from balance sheet is, the higher the portion of liabilities in the right hand side of this equation, the more troublesome it is for the company, because at the end of the day, no one likes a company which is very much in debt. Because if, let's say, the any situation like COVID or any particular trouble that arises in front of the company, it becomes difficult for the company to pay the loans back in time. So if the company has a very huge sum of liabilities with it, it is basically regarded as a negative thing for any company. Now, the various things that you can uh, analyze using a balance sheet is, what is the total asset base of a company. So when you compare a company like Apple and Google, you can see if which company is bigger, which company has more in assets. So one thing also to understand here is, it can very well be the case that a very small company which is in a different sector has a higher asset base than a company which is quite successful in its sector, but have a and can have a lower asset base. Because for manufacturing companies, for companies like operating in the aviation sector, their asset base are huge. They basically have the planes with them. For the manufacturing, they need to set up their own factories and buy their own machineries. So their asset side is a bulky one. And for the retail players like Walmart, players like Flipkart, their asset side is not very much. They mostly have the inventory in hand, and they do not invest in machinery. So their asset side is going to be the light side. So this is the difference between a capital intensive industry and the capital non intensive industry. So retail segments and the segments who are not into sectors which are not into manufacturing and buying the huge assets, so they are capital light sectors. And the sectors which are into buying of assets, setting up firms, setting up manufacturing, so the automotive plants. So if the take the case of Maruti Suzuki, they need to set up their huge plants before producing the cars. For the cement factories, Ultratech and those kinds of firms, so these are very capital sensitive, capital intensive industries. So the one advantage and one disadvantage of being a capital intensive industry is, if you are a working in a capital intensive industry, it's very difficult for the new players to come into the market, to basically no one guy can decide today, okay, I want to start manufacturing my own cars and start selling it, uh, and then you can set it up in, let's say, next year or so, because you need huge amounts of capital to do that. But let's say if they take the case of Amazon, Flipkart, and the e-commerce or the tech firms, the high frequency trading firms, so these are very capital light industries. You do not need much capital to start doing business in these sectors. you can start doing your business with a very minimal amount of capital. So these are the kind of things that one needs to consider before analyzing the company, like what particular sector the company is running its operations in, what are the different key things that this sector runs on, and then you basically analyze your income statement and balance sheets and other information which is provided to you. Now, the third statement is the cash flow statement, which we won't go into the greater detail. So, what happens is with respect to the income statement and balance sheet. Now, one thing we'll clear with respect to the accounting policies. So, when these statements are done, when the Flipkart reports the profit of 2.8 crore rupees, it can very well be the case that it does not have the 2.8 crores with them at the end of the year, because what happens is they might have done some purchases on credit, they might have done some sales on credit, and these things are not captured into the income statement. So the accounting policies that we follow is based on the accrual system. So let's say take the case of Hotstar. So let's say Hotstar is running a scheme where they offer you the 1 year subscription at 1500, but a 2 year subscription at 2000 rupees if you pay upfront the entire amount. And let's say if someone pays the entire 2000 upfront, so the income statement don't won't report the revenue of 2000 in this year, because that 2000 is paid for 2 years. So only the proportion for this year, which is 1000, is recorded into the revenue side. So this is how the income statements are made. So to overcome this limitation, because this does not give us the actual movement of cash that the company has gone through in this particular year, there is this third statement, which is termed as a cash flow statement. So this particular statement basically gives you the cash. So this particular statement will has three segments: cash flow from operations, cash flow from investing activities, and cash flow from financing activities. Now, the cash flow statement, under cash flow from operations, this will record the entire 2000, because the firm has received the 2000 rupees today itself. So this is a very important statement with respect to the business policies and the business ethics that the company is following, because it can very well be the case that a company is reporting huge profits from in last couple of years and is still reporting, but they have very low cash flow generation, or basically they are doing sales on credits just to balloon up their sales and to increase their profit or margin, but in actuality they do not have the cash with them. They basically did not in real earn that money on books. In income statement they have definitely sold good enough amount, they have sold off the goods, they have earned the money, but they did not receive the money. So this is the third statement, which basically takes care of this particular thing, and which an analyst and the investors need to monitor closely, so that they know that what the company is saying through income statement, they are generating close enough to that amount, and that you can ensure from the cash flow statement. So is it still low sound? I just read the message. Now, so this is what we have talked about, the equity thing. So when we said that the Flipkart is divided into 100 crore shares, so this is basically the equity side of the field. Now, with the equity side of the field, there is this particular thing, the loans. So when the corporates go out, into the market, and they say that there are only two ways for the companies to raise money. So one, as we had discussed, was through IPO. The second one is if the Flipkart owners decide that they do not want to share the profits, they do not want anyone else in their company as owners of the Flipkart in whatever percentage, but they do need the money. So like what they can do now. So the another way of raising the money in the markets is through the bonds. So now we'll understand what the bonds are and how they differ from equity. So first let's get into some little theoretical knowledge. So the bonds are basically guaranteed by the company. They have regular interest payments and principal repaid at maturity. They are defined income and they are termed as loans. With equity, as we discussed, that there is no guarantee of dividend payments or return of capital. So what is the return of capital? Let's say you had purchased 10 shares at 100 rupees of Flipkart, which is basically 1000 rupees that you had paid to the Flipkart. Now this is the not exactly to the Flipkart, but to the guy who has sold his or her share. So this 1000 rupees can very well go to the 10,000 or to the close to zero amount as well, because if Flipkart does not perform well, its share price might decrease from 10 rupees to from 100 rupees to 10 rupees, 5 rupees, or if they are doing a very good business, if you feel, and if they did a good job in, let's say, 2 or 3 years, and then their share price can very well rise up to the 100, from 100 to 1000 and whatever number. So there is no guarantee as such. It all depends upon your sense of the company and how the company performs. Expectations of growth in share price and dividend is what the income that you as an investor is aiming, that either the company share price will grow or they'll pay the dividends out. Whereas in bonds, there are regular interest payments. Now, what the bonds are, so if Flipkart decides, okay, they do not want to go into the equity market and raise the money, they do not want to do that initial public offering. So what they'll do is they'll go to some investors, they'll ask for the loan. And this is what the bond is. Then again, there are two ways of doing this. They can either go to some private investors, which now, as the case that in the case that we had taken, they have basically squished that possibility. And so what they'll do is they'll go to the public market, they'll come to the local investors like you and like me, and they'll issue the bonds. So what they'll do is they'll ask us, okay, give us the 1000 rupees today for every bond you buy, give us the 1000 rupees, and we'll pay the 10% interest per annum for 7 years, and we'll give you back your principal at the end of 7 years. So at the end of each year, you will receive the regular interest payment of 10%, which is 100 rupees. So at the end of every year, you will receive 100 rupees, and at the end of seventh year, you will receive the 100 as an interest plus the amount that you paid out upfront as a principal amount at the end of seventh year. So at the end of seventh year, you will receive the 1100 rupees. So this is the difference in between the, this is the major difference between bonds and equity. So in bonds, investors do not bother about how much company is earning or how the company's performance is in any year. They basically are bounded by the contract, and they basically are just worried about their interest and the principal. So this is basically what we asked about, what we explained about the loans or about the liabilities in the balance sheet. So this section is what basically the liabilities side, and this section is basically what's the shareholders equity side. Now the thing about bonds is, if the company go bust, let's say if Flipkart says, okay, they are not able to maintain their business, and if they file for bankruptcy, then the whatever proceeds that are generated by selling off its assets and by selling off its assets, they are first paid out to the bondholders, because they are their preference in the money is above than the equity holders. So the equity holders are basically owners of the company, and thus they will receive the money after paying out all the obligations. So this is one again major difference between the bonds and the equity side. Now to understand, so this is the main difference. Now you can go into the greater detail about the bonds, how they are priced, how so the pricing of the bond is done. So let's say if the interest rate, the coupon rate, which is called as the interest, which defines the interest payment. So if the coupon rate is, let's say, 10%, so that means, and the maturity is, at maturity you will receive 1000 rupees. So you have the cash flow at t equals to 1 year as 100, t equals to 2 year as 100, and going to t equals to 6 as 100, and at t equals to 7 you have 1100 rupees as a cash flow. So you discount these cash flows. Now to understand the concept of discounting, the one question which we should think is, what would you prefer if I promise you to give 100 rupees today or 100 rupees at the end of 1 month? Or to make it little more clear, what would you prefer if I promise to give you 100 rupees today or 100 rupees at the end of first year? So everyone will basically prefer the 100 rupees inflow today. They would definitely don't want to wait for 1 year before receiving the same amount. So this is the time value of money, that the 1 rupee today is higher than the 1 rupee tomorrow. So basically with every passing day the value of money is going down. So what to put it things into more better perspective, so what the 100 rupees in 1990s could buy, they definitely cannot buy that same thing or same quantity at today. So from 1990s to 2020, the value of money has gone down. So this is what the inflation is. So inflation is basically what your price of goods increase and thus your value of money goes down. So the 100 rupees at the end of this year is lower than what 100 rupees is today. Now if I say I promise to give you 110 rupees at the end of first year, or you have an option to take 100 rupees today, what would your preference would be? So for some people they will prefer 110 at the end of first year, and some they might prefer 100 rupees today. So this difference of 10 rupees is what we call what is understood by the concept of discounting. So basically for those who chose to take 110 rupees at the end of first year, you are willing to take that risk of waiting 1 year and receiving that payment, and you place the cost of that risk as 10%. So when you bring that 110 rupees at the end of first year and discount it by 10%, so how you do is 110 rupees divided by 1.1, which is 1 plus 10%. So when you discount that 110 rupees at the 10%, you receive the 100 today. So this is the case. So for people for whom these two things are identical, they are indifferent between choosing the 100 today or 110 tomorrow, their risk return profile is basically now stands at 10%. So basically they want either 10% return from the amount today, or they just want the amount today. So this is the case. So this is how any bond is valued. So basically what you do is, now you have the future cash flows with you. So you have that 100 till 6 times and 1100 at the end of 7th year. You discount these cash flows with respect to the years they are away from today. So the first cash flow will be discounted once. So that is 100 divided by, let's say, the rate which by which we discount this particular bond is 8%. Let's say for the sake of example, this is 8%. So you divide first 100 by 1.08, you divide the second 100 by 1.08 square, you divide the third 100 by 1.08 cube, and so on. You divide the 1100 at the end of 7th year by 1.08 to the power 7. So this is, so when you add these 7 terms, you will get a number which will be higher than the 1100. Let's say it comes at about 1200. So you will pay the 1200 today. You will pay out the 1200 today. The Flipkart promises you to pay the 100 7 times and 1000 at the end of 7th year. So this is how the bonds are constructed. So this might be a little confusing for a few of you. So the very good source to clarify the basic doubts, the terminologies that you do not understand is investopedia.com. So just do the basic search, what the bonds are, what the coupon rates are, how the bonds are valued, how the equity is valued, and so on, and then you can clear most of your doubts. And these will be the questions that your interviewers will be asking in your interviews if you do not have written much about finance, because these are the very basic building blocks of this field which you should know if you are sitting for a finance interview, and you should be able to explain to the interviewer what's the difference between the bond and equity, how the bond is valued, and what are the different concepts of premium and discount and time value of money and those kinds of things. Now we have studied both bonds and we have studied both bonds and both we have studied both bonds and equity now. So equity is basically the ownership, the bond is basically the liability for a company. Now we have studied the valuation of the bonds, so let's spend few minutes on how to value the equity. So to value the equity you need to first have the income statement, balance sheet for this particular year, the financial statements at this particular year ready with you. And then what you do is you forecast the performance of the company, let's say to the next 5 years. So the way of forecasting, the very crude way of forecasting is you start with the income statement. So let's say you believe that the revenues are going to increase at the pace of 5% per year for next 5 years. So this is the basic assumption that you start with. Don't need to worry about much. You just do the crude modeling and you start with the 5%. And to explain how the 5% come, let's say the Flipkart's market share in the e-commerce is 20%, and the market, that entire market is expected to grow at 10%, and let's say the Flipkart's market share is 50% in it. So if we assume that the market share of Flipkart is going to remain constant for the next year as well, the revenue for the Flipkart will increase by the same percentage by which the market is increasing. So these are the two components by using which you can decide how much revenue growth that we can assume for any particular company. And there are a lot of different ways of forecasting, but let's just get into the very crude one. So you start with the revenue, you forecast the revenue by 10%. So let's say 10%. So at this year it was 20 crore. So the next year it would be 22 crores. So now what you can do is you can basically take all the income statement items in proportion to the revenues and forecast them. So let's say if previously the cost of goods sold was 12%, so the next year your cost of goods sold would be 12 divided by 20 multiplied by 22. And similarly you can forecast the entire income statement for next years. And similarly you can do for balance sheet, you can take everything as a percentage of either revenue, or you can see if you can check if the assets are going to you can assume if the assets are going to increase at any particular rate, and then you can forecast the entire balance sheet. So once you have these things with you, what you can do is you forecast the different cash flows. So the way we value the bond, so the way we value the equity is very similar to that particular valuation model where you discount the future cash flows and arrive at the current valuation. So let's say let's get into the discounted cash flow model. So let's say the cash flow, and note this down, this you can Google the lot of cash, the way you can calculate those cash flows are FCFF and FCFE, which is the free cash flow to the firm and free cash flow to the equity. I repeat, FCFF, FCFE, free cash flow to the firm and free cash flow to the equity. So you will get the formula from the Investopedia, and you calculate that particular number for each of the next 5 years. You discount that particular number with the appropriate rate, and to determine the rate you can use the CAPM model, which is the CAPM, capital asset pricing model. So once you have these inputs with you, you can again apply the same formula where you discount the each year's cash flow by the number of years it is away from today at the rate which you seem appropriate, and then you will basically arrive at the value which you find is should be the valuation for Flipkart. And let's say by doing this exercise, we see that the Flipkart's valuation by our model arrives at 80, but the Flipkart is trading at 100. So we believe that Flipkart is not a good investment, because according to our expectations, according to our modeling, our intrinsic value for this particular company is 80 rupees, whereas it is already trading at 100 rupees. So the company is trading at a premium, or it's overvalued, and we will not going to be invest in this stock. And if our valuation comes at 120, we believe that Flipkart should be trading at 120 rupees. So we'll invest in Flipkart with an assumption that our forecasting comes true and the stock value reaches 120 and we make profit of 20 rupees per share. So this is the discounted cash flow approach for valuing both bonds and equities. Now, the other valuation methods which you can study are price to earnings ratio, price to book ratio, and the EV to EBITDA multiple. So these are the various other valuation techniques that you can study uh, on yourself. Now, so when we have studied both the equities and both the bonds, so basically now the third and the most important instruments are derivatives. So so the bonds, the equities and derivatives are called the financial instruments. So what are the derivative instruments? So a derivative instrument is a financial security with a value that is reliant upon or derived from an underlying asset or groups of assets. So uh, we are very clear what equity is, what a bond is. Equity is basically a ownership in a company. Bond is something that a contract between investors and the company, where investors have lent out the money today in hope of getting some interest and the loan at the end of the maturity. So these are the two instruments. These two have some physical significance attached with them. Now, what are the derivative instruments are? So the derivative instruments do not have any physical significance. These are just the instruments which are created as per the need of the investors. Let's say I do not have much capital with me, but I'm very eager to invest the huge amounts in Flipkart, but I do not have money with me. So then there comes the concept of leverage. Then there comes the concept of options and futures and different derivative instruments. So one thing you need to understand is these do not have any physical essence attached to them. Their value is totally dependent on some underlying assets or group of assets or some other economic variables. So the derivative can derive its value either from a stock, from a bond, from commodities, from the currencies, the cryptocurrencies, from interest rates, or from the market indices. What are the market indices are? The Nifty 50, the Sensex 30, that the number of those two indices. So the Nifty 50, Sensex 30, S&P 500, these are the market indices. They give us a broader idea how the market in general is going. If these indices go up, we believe that the economy is doing well. If these indices go down, we it's tend to be the not the favorable. It's a basically the bearish market. So under derivative instruments, the two most common instruments are the futures and options. So we'll first start with options, and if time permits, we'll go to the futures as well. Let me first give you a basic idea of what a future is. So what happens is, let's say uh, you believe that the Flipkart value, Flipkart's share value is going to go to 150 rupees from 100 today in 1 year. But you do not want to invest the 100 rupees today, or let's say you do not have that 100 rupees with you today. But you want to still take part in that particular rally from 100 to 150, and you want to make that 50 rupees profit, but you do not have the required amount to invest 100 rupees. So to overcome this challenge, what the industry has done is they have come up with an idea called the futures contract. So what a futures contract do is, so what a futures contract will do is, let's say if its stock is trading at 100 rupees today, so you go into the market and you sign a futures contract, and let's say you sign the contract at the strike price of 110 rupees, and you buy the contract, you buy the futures contract at 110 rupees. Now how this particular instrument works is, you basically do not pay any amount today. You have the right and both the obligation to buy the share of Flipkart from the guy who has sold you that contract at the end of first year by giving him 110 rupees. Now what happened is, let's say I come to you and I say that I want to buy a futures contract on Flipkart at the strike price of 110, uh, and you sell me that contract, and we will meet again after 1 year, and what we'll do is you will give me the share of Flipkart and I'll give you the 110 rupees. Now, one thing we need to understand is this 110 rupee is fixed today only. This particular number is not going to change throughout its life, which is 1 year. So whatever happens to the share price of Flipkart, if it goes from 100 to 5, if it goes from 100 to 1000, I will have to pay 110 rupees to you, and you in return will need to give me the share of Flipkart. So if my forecasting, if my assumption of the Flipkart share reaching to 150 turns out to be true, I will be making a profit of 40 rupees. So basically, I'll buy the share from you at 110 rupees, which is currently now trading at 150 rupees. I'll go into the market, I'll sell the share, and I have made this 40 rupees in a span of 1 day. Please leave this 1 day thing. It's not technically correct. So basically, you have made the profit of 40 rupees in this particular transaction. Now, what if the share of Flipkart has gone down from 100 to 70 rupees today? So you still need to pay this 110 rupees to get a share which is now trading at 70 rupees. So this is what a futures contract is. This is a right and both an obligation for each of the parties to honor their commitment which they have signed today. So keeping things in mind today, and now one question might be coming to someone in someone's mind is, why anyone will sell me the contract? So how this happens is, I can be of the opinion that Flipkart share price is going to rise, and you can be of the opinion that Flipkart's share price is going to go down, and you when you do not want to wait for that particular event to happen. So what you do is, if it's trading at 100 and you basically need money today and you don't want to sell that particular share, what you will do is, you'll come to me, you will say, okay, let's sign a contract that whatever happens in the future, I'll give you the share of Flipkart and you give me the 110 rupees at the end of 1 year. So there are two parties involved in this transaction, I being the buyer, you being the seller. So I will gain, this transaction will be economically beneficial to me if the share price of Flipkart rises above 110 rupees. And this particular transaction is beneficial to you if the share price of Flipkart is below 110 rupees. And the amount that I am gaining theoretically is equal to the amount that you are losing. And this is the case. So go into the greater detail about how the futures contract works. And there is this another contract, forward contracts. These are not the structured contracts. These are basically entered into the uh, as per the requirements of the investor by, and they are offered mostly by the banks or the market makers. So this is one contract. I hope this is clear how this particular instrument works. Now, once we understand this, the futures contract. Now, what I want is, I as an investor want some facility where I want to buy the stock of Flipkart only if it rises in the price. That I do not want to pay if from 100 it goes below and it, let's say it goes to 70 rupees, then I do not want to have that 40 rupees loss. I do not want, I want that facility as well. So to take care of this particular this particular segment, what the innovation was done was, the options contract were coined. So what is option is, so there are two type of options. One is a call option, one is a put option. Now I'll say what a call option gives you. The call option gives you the right to buy in future, but you are under no obligation to buy. So now the how this is different from futures contract is, under the futures contract you are not paying in anything to the seller. So the guy who is selling you the contract and who is promising to give you the share at the end of 1 year, you are not giving him any penny today. And the it's basically, you are in futures you are signing the contract today for the transaction that is going to happen in the future. This is how the futures contract is understood. You are signing a document today for the transaction which will take place in future, and the terms of this particular transactions are defined at today only. So this is everything in the futures is fixed. It's just the signing today at the terms which you are going to trade at the end of first year. But in options, what you do is, so if you want that facility to buy only if it's feasible to you, you need to pay something to the seller of the option. So if you want to buy the call option, you pay the premium to the seller of the option, and that basically is the price of the option, that the amount that you pay to the seller of the option. And this basically then gives you the right to buy it in the future, but you are under no obligation to buy it in the future. Now, let's say the stock is trading at 100, and let's say the strike price, you believe that this is going to go at 150. So what happens is, you go to a bank, you basically buy an option with a strike price of 110 rupees, and you pay the small premium, let's say it's about 7 rupees, to the broker. Now, that 7 rupees is basically your cost to buy the option and to get yourself free from that obligation. Now, when you pay the 7 rupees, when you buy the particular option, that 7 rupee you are never going to recover. If you choose not to buy the share using that option, you will still not get that 7 rupees. So that 7 rupees is basically now your expense that you have incurred today for buying that option. Now, and this option, what it does is, if the strike price under this particular options contract is 110 rupees, so this call option with which you bought at 7 rupees gives you the right, this call option which you bought at 7 rupees today at the strike price of 110 rupees, where when the stock is trading at 100 rupees, gives you the right to buy the share of Flipkart at 110 rupees in future. It's up to you if you want to buy the option, buy the share or not. If the share is trading above 110, from 111 to any price, you will definitely go out and buy the option, buy the share using the right that you have under your contract. But if the option, if the share is trading below 110 rupees, you are not going to buy the share, because this option is giving you the right to buy at 110, whereas you can go into the market and buy directly at, let's say, 107 and 108. Now, how the profit works in this particular scenario is, so let's say if the price of the Flipkart share is anywhere below 110, let's say it's at 105, so your loss is 7 rupees. Basically, you have lose out the 7 rupees for buying the option, which basically did not give you any benefit in future. So the total cost is 7 rupees. This is the amount of money that you have lost, and this is the total cost of the option. So if the price of the Flipkart share remains between 0 to 110, your loss is limited at 7 rupees. However, whatever be the price that it trades at the end of first year, from 100 rupees, from 0 to 110, your loss is at 7 rupees. But let's say if it trades at 111, 112, then basically you can buy the share using this option contract at 110, sell it into the market at 112, and you can make the profit of 2 rupees using this option. So your profit would be minus 7 plus 2, because 7 rupees is what you paid out as premium and 2 rupees is what you gained from the call option. So then your profit will start increasing from 100, and when the share price reaches 110 to 117, your loss will start decreasing from minus 7, from 7 rupees to 0 rupees. So if the share traded 117 rupees, this is your break even point, and if the share price goes above 117, you start to make money. So this is how the options pricing, options are trading. Now to price, and then similarly there is a put option which gives you the right to sell it in the future, and try to uh, graph its payoff chart, how the profit is going to be in this scenario. What is, if there is a so under the call option there is no limit to the possibility of the profit that the buyer of the call option can make, uh, because if theoretically share price can go to the any extreme level, and that is going to, and this is an uh, unbound number, and thus your profit is basically limitless in the call option. So put option basically gives you the right to sell the share which you own today in future. So this is how the put option is structured. uh, this is, you can go into the detail, you can try and plot the payoff charts for all the four scenarios. If you are a call option buyer, if you are a call option seller, if you are a put option buyer, if you are a put option seller, try to draw the charts, and then once you have a good hang of these two options, you need to understand that there are a lot of trading strategies involving the different combination of the call options. So how involving the different combination of these call and these put options. To add more flavor to it, there are a lot of options at different strike rates for the price. So you will be able to buy the call option, which gives you the, if the share is trading at 100 today, you can buy the call option which gives you the right to buy at 80 rupees, 70 rupees, 90 rupees, 100, 120, 30, 40. So if this strike price is greater than the, let's not get into it. So basically these are the different combinations, and using the different strike prices and the different combinations of call and put options, you basically cover the different option strategies. So first thing to start here is try the try and draw the payoff graph for futures contract if you are a buyer of a futures contract, if you are a seller of a futures contract, and if you are a buyer and a buyer of a call option, seller of a call option, seller of a put option, and buyer of a put option. So under these 6 scenarios, try and draw the uh, payoff from this particular instrument depending upon how the share price of the Flipkart share changes from 100 rupees. So on the x-axis, you can plot the share price of the Flipkart share, and on the y-axis, you can plot your profit and loss. So this is basically, this is a very good starting point for you guys if you are genuinely concerned, and if you genuinely want to have a good shot at cracking the finance interview. So couple of things again: prepare your CV and give the interviewers a fine idea that you have done something, some courses, some projects, or basically you have done some assignments or some internship, if you can, if you had done. So give them that flavor that okay, I am not just coming to in this interview because either I do not have other opportunities, or I'm just coming because I just want a job. Give them that impression that you are genuinely interested in finance, and how you can give that impression to me if on that particular one pager CV I see that you have done some bit of finance here and there, and you know something in this particular field. See, I do not expect much from you given the background is the technical college. I definitely do not expect that I will get the finance stud CV from this college. So you don't need to uh, do a lot of hard work in proving that you are interested. The advantage here is because I do not expect it. So just give me some flavor that you have done some assignment, some course, and that would be enough for me. And again with a pinch of, again with a touch of some probability and statistics course and some coding, because some coding is will give you a good enough chance to tap into the fintech sector. So this is all from my side. Feel free to reach out to me. You can log into the Preply for more exciting content, assignments, and some courses which I am offering in the field of finance. And those particular courses will basically give you the huge insights, and I teach into the more detail of the statements. We do the ratio analysis, we will do the modeling, financial modeling in those courses. And if you do those courses and with those certifications, uh, that would be more than enough for you guys to sit for any financial interview and to crack it. Thanks a lot guys, and all the best for your placement season.